All right, hello. It's already episode number 3. If you can believe it, the questions keep coming in, so we better keep answering them. And you might also notice there's a new logo, a new song, and a new shirt to go with this. And it's all part of the YouTube experiment. And my son and I are finding this super interesting because we've never taken YouTube seriously before, but we watch a lot of YouTubers and see how quickly certain channels go up to crazy levels of popularity. Other ones which seem quite good don't really get anywhere, seemingly at random. So part of the show is going to be perhaps deciphering some of this stuff. If you look around in my channel, you'll see I interviewed a mustachian from my area who has a successful YouTube channel of his own where he makes a living. And he taught me something around, if you get around 500,000 subscribers and you work just a little bit at monetizing your YouTube channel, then that can be a solid living, like maybe $80,000 to $100,000 a year if you have that many subscribers and maybe you have a sponsor or the right kind of advertising. So YouTube can be a living, even though I'm not trying to make this show into it. We still want to learn about YouTube and see if it can become a business for other people. So that's our little side of it. Getting into the reader questions. Our first question is a pretty easy one. It's from somebody called the Unmasked Magician, who says, this is a super common question that everybody gets if you're a finance blogger. Should one pay off debt first and then save for retirement, or save for retirement first and then pay off debt? Question mark, question mark. And actually I see that Supermoto Central has already come in and offered a preliminary answer of his or her own that says, pretty hard to save for retirement when you have to pay off a lot of debt, ... And that's actually a wrong answer. I think people are often confused and they think these are two different things, but it's all really exactly the same. If you have zero money, that's like a zero net worth. If you have debt, you're below zero. If you have investments, you're above zero. And sometimes you have both at the same time. So you have to subtract your debt from your investments to find out your total net worth or your net wealth. But the real answer, there's always a real answer, and that is just, it depends on the interest rate. So if you have credit card debt, for example, that's charging like 17 or 20 or 25%, yeah, that's an emergency, and you should pay that off, not only before you make any investments, but before you buy anything other than potatoes for for your next meal, because that's a huge emergency and it's just sucking away your wealth like a vacuum cleaner. In between, you might have stuff like student loan debt or auto loan debt or whatever that's around 6 or 7%. And as luck would have it, that's around the same amount you can expect from stock market investments. So it's kind of up to you which one you want to do first. In general, I would lean to paying those off first because they're a bit of a psychological drain and people often feel more spirited when they're out of debt. And plus those type of debt payments are often not tax deductible, whereas the money you earn from your investments will be taxable. So just get after it, pay off those wimpy little student loans and auto loans and stuff before you're going into serious investment. There's one exception to that too, though, not to get too complicated, but if you are employed and your employer has a good 401k plan and they have matching, or if at least the 401k is tax deductible from your pre-tax dollars, then you should put money into that even while you have the other debt. Just kind of max out that and then put the remainder of your money paying off your debt. It's all like little details. This stuff's not going to matter to you much as you get further along in financial independence, because we are going to be talking about much bigger numbers than what your current debt is. But for now, just look at the interest rate. That's a quick answer. All right, moving along to question number 2. We have something from, man, where do people get these usernames? Okay, so somebody named Lal Safask has written in saying, great show. Oh, thanks. I'm invested only in real estate for the time being, and the cash flow has surpassed my living costs, even taking into account possible vacancies and repairs and capital expenditures and stuff. And the return on my investments is over 6%. Am I financially independent because this happened even though my total assets are only 17 times my yearly expenses? Is the 4% rule still applicable to real estate, because you basically can't sell a house in chunks like you do with stocks? Okay, so in case you haven't heard what he's talking about in general is if you're a stock investor, there's something called the 4% rule, stating that if you have a chunk of money, you can live on about 4% of it per year and it will last more or less forever, because of things like dividends and appreciation in those stocks. So the quick answer to this one is no. Real estate is totally different from stocks, and the 4% rule doesn't apply. Real estate can be worse or better. And in this case, it sounds like you're a little bit better because you have, let's say you're living off, just to make a round number, $10,000 a year, and he has 17 times of that amount invested of $170,000. Really, the numbers will be bigger. But he's able to pay for his groceries and all his bills and stuff just with rent that's coming in from these houses that he owns. So the answer is yes, you are financially independent in this situation. It's not a true retirement job because you're still managing the properties, or you have to manage the manager of the properties. It's not quite as passive as stocks, but it's still very, very good. I've had rental houses before that take very little work to run, and a lot of my friends do, and it's a great way to go, and it's a way to get yourself to retirement sooner. And especially if you're doing the accounting conservatively, like, for example, these houses are appreciating probably as fast as inflation, or maybe even a little bit faster depending on where you live. And if you're not counting that, and if you're just counting the rent and the cash flow that's coming in, and maybe you even have mortgages on these houses and you're using the rent from the tenants to pay off the mortgages quietly in the background, and then you're not even considering that as part of your income, well, then you're really being conservative, because what's going to happen is those mortgages will eventually be paid off, and then 100% of the rent minus just some tiny expenses, most of the rent's just going to be coming right to you, and you can live off of that. And then eventually these houses will be worth a ton, and you can sell those, and then you have an even bigger retirement chunk to like live off more passively when you're older, if you don't want to manage them, or you can pass on that money to charities or to your heirs. So in summary, good job. If you're happy with this strategy, then you never have to go into stocks. You can just stick with real estate, and it's a really, really common path to early retirement, and I highly advise it for anyone who has the stomach to handle that kind of work. It's good for you. All right, next up we have a Jose Chung 21 who asks a question. Triple M, can you clarify your current thinking on how to invest FI money, including dealing with large one-time cash infusions, like selling a house maybe, or an inheritance or something like that? I understand your portfolio grew quite nicely even during an only decent market environment. Does the recent market madness have you rethinking what works? Would a dividend aristocrat stock strategy be optimal to pursue? It's kind of, this is like almost a stock market timing question. And I usually advise people to just keep it simple. And the simple advice is, whenever you have money, as soon as you get it, you just chuck it right into the stock market, and you don't even look at the price, because on average, you're going to get the average price of the market. Sometimes you'll get a bargain. Sometimes you might overpay a little bit. But if you trickle that money in throughout your working career, you're going to be fine, because the stock market basically always goes up. If you zoom out far enough and look at the graph, it smooths out as long as the economy keeps growing and remaining productive. And as long as you're not betting on individual stocks, which could be bankrupt, some of them if you guess wrong, you're going to be fine buying the entire US index fund. And then so his second question is about, would a dividend aristocrat stock strategy be good to pursue? So this is a different method, and I do have a blog article about this. We'll put it in a little information box up here right now. But that's an alternative strategy. It's not proven to work any better than buying all the stocks, but some people have a bit of a philosophical attachment to it, because so you're buying older stocks that are growing less quickly, but in exchange they pay higher dividends, stuff like General Electric and railroad companies and utility companies, and even like motor companies. Ford Motor, for example, pays a really high dividend right now. It's a fine thing to do, but first of all, you're going to be paying taxes on your dividends annually, whereas if you buy the whole market, you'll have lower dividends and higher appreciation, and you only pay taxes on the appreciated shares when you sell them. But I'm not super against dividend stock strategies either. It's not like you're going to drive your investments off a cliff if you do that. So if you read enough books about it and you want to do that and have fun with it, then go ahead. But regardless of that, the real answer is, when you get chunks of money, just put them into the stock market, and it really doesn't matter what's going on right now. So I retired in 2005, just before a little market run up and then a huge market crash, biggest one in my lifetime. And then since then, a really big market run up. If you take the total path of my investing career, it's starting to look more normal because I started in 1999 and now it's 2000, almost 19. So now I have 20 years of investing in stocks. So it's starting to get more and more normal. And that's what happens, is everything kind of reverts to the mean over you get as you go through several decades of investing. I haven't had much good luck or bad luck in stocks. And that's how it's going to be for you too if you do it across a whole lifetime of investing. All right, so those are pretty easy questions. I think we have time for one more pretty easily, especially because we control the show length here. It's so much better than real TV. So here's one from Aaron Levin. Question: if you like your career and you have excellent long-term prospects and make good money and already save 20% of your income, is there much point in going hardcore with trying to save 50% or more of your income? Yeah, I get that question a lot too. And I think it really depends how much you make. So if you're making, like, let's say a huge salary, like $200,000, then yes, you should save at least 50% of your income no matter what, because what the hell are you going to do with spending $100,000+ a year? That's just a ridiculous lifestyle. It's going to make you disconnected from the real world. Nobody needs to really consume that much to be happy. So it's like a personal challenge to be efficient. On the other hand, if you're living on like 50 grand, and it might, and especially if you have a family, it might really start to have to squeeze you to save 50%. So, take the top line into account when making this decision. Secondly, if you like your career now, are you really sure you're going to like the career forever? I mean, this person did not explain how old they are, but as a 44-year-old, I should point out some wisdom, as if I am your elder, that shit can get old pretty fast. You might think you like your career now, just as I did when I was like 21 as a software engineer, but eventually, like, I was doing the same thing year after year, and I was looking at the beautiful office building windows that people like mountain biking and snowboarding, and I was still locked up in there, and I realized, yeah, I would like to be free. So make sure you're not selling your future self short by assuming future self is going to be the same as you are right now, especially if you're going to be having kids later, and if you don't have them now, that's a huge change, and you'll probably or certainly want a lot more free time for that. Or if you have new interests, or like, let's say you run into a health problem, or your family members run into a health problem and you want to be able to help them, or if you want to be able to live in a new country, all these are reasons to not be locked into a job. I think the best thing you can do is get yourself to a financial independence position pretty early in your life. And then if you like your work, you keep doing it, but you always have this freedom just tucked into your pocket, and you can whip it out whenever it's time to make a change. So that's pretty much it for episode 3. This has been a surprisingly easy thing to do, so this show might turn out to be a sustainable effort after all. However, the great father and son Christmas break is just about over, so we're probably going to take some time off to do some offline things, and I'm going to go on a trip, and the boy's going to go back to school, so we'll probably move to a less frequent schedule, maybe once a week. We'll see how it goes, but thank you for following the show so far. And if you'd like to subscribe, like they always say, or toss in some more questions, or keep providing feedback, then let us know. We'll keep making it better. Thanks a lot.